In this example of merger and acquisition, we will be covering topics such as exchange ratio, pre and post merger EPS, the market capital, capitalization, and the calculation of NPV. The data given to us is that pre-merger of company A, that is earnings 2000, number of shares 200, price earning ratio, that is 10, EPS, that is 10, and price, that is the market price, is 100, whereas pre-merger data of company B is 4000, number of shares 1000, price earning ratio is 5, EPS 4, and price, that is the market price, is 20. Now the post merger, that is company B is acquired by company A, and the resulting company, that is the post merger, that is after merger, will be the company A, and the exchange ratio given to us is 0.2. So the first question, that is number of shares to be issued to company B shareholders. So number of shares of company A is 200, whereas pre-merger company B is 1000. Now exchange ratio is 0.2. So company A shares will be issued to the shareholders of company B. Now what does this exchange ratio means? That is 0.2:1. That is for every 1 share of company B, they will be getting 0.2 share of company A. So 1000 multiplied by 0.2. So they will be getting 200 shares of company A. Or I must say that 0.2 share of company A is equal to every single share of company B. So the exchange ratio of 0.2 will result in 200 shares of company A. Now let's move on to the second question, that is calculation of pre-merger and post-merger EPS, that is before merger and after merger EPS. So pre-merger EPS was given in the question and it is very simple, that is earnings divided by number of share using the pre-merger data. So that is 10 in case of company A and 4 in case of company B. Now post-merger EPS, here we need to take care of one thing, that is the number of shares. Now earnings after merger, that is post merger, is 6000. Number of shares are not 1200, they are 400. How? Because 200 were existing shareholders of company A, they still exist, whereas company B shareholders will be getting 0.2 share of company A, that is they will be getting 200 shares of company A. So 200 plus 200, that is 400. So the post merger EPS will be 15. Now moving to question third, that is exchange ratio. What should be that exchange ratio so such that the shareholders of company B are not at loss? Now what does this question mean? First let's understand. The EPS, that is the pre-merger EPS, is 4 per share, that is 4000 divided by 1000 that we calculated earlier. Now this exchange ratio, what should be that exchange ratio so they are not at loss? Now the current exchange ratio, that is 0.2. Now when we use that 0.2, the EPS was 15. That means they are issued 200 shares, that is 1000 multiplied by 0.2, and the value per share, that is earnings per share, is 15. So here you will see that the earnings that is available to them is 3000, whereas pre-merger was is 4000. So they are at loss of 1000. So what should be that ratio such that the ratio is equal to 4000? Now the pre-merger EPS is 10 and 4. So the ratio should be such that it is in proportion of this EPS, that is 1 share of B, that is EPS 4, whereas 1 share of A, that is having EPS 10. So the ratio should be 0.4, that is 4 divided by 10, that is 4 EPS of company B divided by 10, that is EPS of company E. So the shares issued to company B will be 1000 multiplied by 0.4, that is 400. Now in this case, when we are having 0.4 as exchange ratio, the EPS will be 10. That is 200 plus 400, that is 600. So in this case, they are getting 400 shares. Each share earnings per share is 10, so it results in 4000. Now that means at the exchange ratio of 0.4, the shareholders of company B are not at loss. So that was calculated using the ratio of EPS. Now moving to question 4, that is the market price. What is the market price post merger? So the ratio that we will be using for calculating the market price is price earning ratio. That is the price earning ratio, earnings EPS, that is 15 multiplied by 9, that means 135 per share will be the market price. Now, for example, if in question this market price post merger is not given to us, that is price earning ratio is not given to us, so we will have to take an assumption, and the assumption will be that post merger price earning ratio is equal to the price earning ratio of acquiring firm. So for example, if it was not 9, that was not given to us, so post merger price earning ratio will be equal to 10, that is the price earning ratio of the acquiring firm. Now question 5th, that is calculate the value of company after merger. So we know that the price per share is 135, the number of shares, that is 400, that is 200 plus 200. So the market value or the market capitalization will be 135 multiplied by 400, that is 54,000. Now this is one of the important questions, that whether shareholders of company A and B are better off or worse off. That means they are in profit or loss, or in simple terms the question is asking us to calculate the net present value. So let's have a look. To calculate the net present value, how we are going to calculate it, that what was the pre-merger value of the company A and company B, and what is the post-merger value. So pre-merger value will be 200, that is the number of shares multiplied by price, that was pre-merger price. So that is 100, that is EPS multiplied by earnings per share, that is price. So 200 multiplied by 100, that is 20,000. Similarly for company B, 1000 multiplied by 20, that is 20,000. Now post merger value. So post merger value we know. Now these are the number of shares that will be issued. Now the post merger price is 135. So 200 multiplied by 135, and here also 200 multiplied by 135. So NPV in both the cases is positive, that is 7,000 and 7,000, and hence the merger is viable. Now the last question, that is what is the equivalent earnings of shares of P Limited. So that is the formula to calculate is number of shares issued of the acquiring company, that is 1000 multiplied by 0.2 multiplied by EPS, that is post merger, that is 15. So 200 multiplied by 15, that is 3000. Thank